most financial news is filler. For God's sakes, don't follow their advice. One size never fits all. They don't know you from Adam, and all they're doing is selling advertising and creating buzz.
Well, hello, everyone, and thank you for once again joining us wherever and whenever you are getting your IRA Cafe podcast. It's always a pleasure to be here with you, sharing some wonderful information from our guests that always joining us. And man, do we actually have a special one today that you are going to learn an absolute mountain of financial information from. My name is Kyle Moody. I'm with American IRA. And again, we love being able to host all the different medias, both on our podcast and our webinars when it does come to the IRA Cafe. Our guest today holds a Bachelor of Arts degree from the University of Pennsylvania and a Master of Science in Financial Services from American College. He earned his Certified Financial Planner certification in 1998 and is also an Accredited Estate Planner, a Certified Private Wealth Advisor, a Chartered Life Underwriter, a Chartered Financial Consultant, a Chartered Advisor in Senior Living, and a Retirement Income Certified Professional. He's a registered representative with Kestra Investment Services and an investment advisor representative with Kestra Advisory Services. The reason I actually brought up all of these accolades and all of the different letters that are out beside of all of that is because, as you know, in the self-directed world, anytime you're on the phone with me, anytime you hear me speaking at an event, the one thing you will always hear me say is that as we are not a fiduciary, I am not permitted, nor is anyone in our company, or really the industry for that matter, permitted to give any financial, tax, or legal advice, suggestions, or opinions. And because of that, you're always encouraged to tap into your trusted professionals in any of those realms. And so that is why we are so happy today to have Eric Brotman, who is the principal and CEO of BFG Financial Advisors, with us to really just kind of trim through some of the questions that I have and any extra information in all of his history in this space that he can share with all of us today. So, Eric, thank you so much for coming on to the IRA Cafe and spending some time with us.
Kyle, thanks for having me. That introduction was lovely, but also a little embarrassing because I'm everything but certifiable. So that's great.
Well, there's a lot. The word certified is on there a lot, but
well, that's yes.
The I
spent a lot of time in school. Yeah, absolutely.
You did. Well, that is the one thing that anybody can really look at. That somebody told me yesterday, hey, you know what? You have actually shared a lot of really good information with me, and I really appreciate that. You know your job really well, and so one of the things that I answered with, other than saying, hey, I'm really humbled to hear that. Thank you. But it is a testament to the time and the studying that we put into our craft to make sure that any information we are sharing is the right stuff out there. From time to time, and I'm sure you've felt the same way, Eric. We hear information that sometimes just isn't correct that's coming from folks. So we've got to break that down, clean that up, and then give them the right information. And then hopefully they're going to be able to decide how they're going to move forward from there. So the one thing that I see from this is that this is the professional. And so, no, that's great. If you can tell us just, a little bit about your company, how you started and how you got to where you are now.
Well, I started in a very non-traditional way. As you mentioned, I had a Bachelor of Arts degree. I actually have an English degree and studied English and psychology and was on my way to law school. I took a year's job at a brokerage firm in the legal department. And after a year, realized I fell in love with the financial business and out of love of the legal business. And I couldn't have been happier to save myself 3 years and six figures and not go to law school. So best career decision I ever made was entering the financial world, and that was in 1994. In 1999, I had an opportunity, after growing my practice and getting some of the certifications, I had an opportunity to join another firm as a startup firm, essentially, where I was the number two guy. I was the sweat equity, and he was the venture capital, if you will. And we started a firm from the ground up and spent 4 years together. And in 2003, the firm I was with merged with another firm, and they took on a different trajectory than really I wanted to go to. And that was that they were only going to work with folks over a certain asset level. And I said, you guys are going to be insanely successful. I have no doubt that's true, but I'm not sure that that's my path. And so we parted on a handshake and a hug, and I started out on my own in '03. So one full-time, one part-time person, and now fast forward to 2025, and we have 21 full-time employees, clients in 37 states, 10 financial advisors, and manage close to $1 billion. So it's been a wild journey. And I have an amazing team around me. If there's one thing I learned early, it was to hire great people, give them the tools they need, and get out of their way.
Wonderful. Well, you talk about what you have under management and the folks that are on staff there, how you've grown, and obviously you've been successful and you're helping other folks realize that success as well. Tell us really quick what someone in your profession does. I mean, let's just break it down to the fundamentals. When someone says, well, hey, I've got my financial advisor, I've got a wealth advisor, is there a difference? If they're trying to find the right person, tell us a little bit about what you actually do.
That's a great question, because all financial advisors aren't the same. Unfortunately, there isn't a linear career track in our field. So unlike law or accounting or medicine, where there's a track, you do some undergraduate work, you have a specific graduate degree, there are residencies or internships or other things you do, and then you're accredited and it's done. Financial advisors have a financial representative or something like it on their business card the day they show up for their first day of work. It's actually terrifying as a consumer. And so understanding the difference between someone who is a salesperson for a specific company versus someone who is a fiduciary who is looking out for clients' best interest is not a subtle thing. It's not a small thing. It's critical. So I consider what we do at BFG to be a little bit unique. There's a couple ways in which that's true, but to look at it from 50,000 feet, our role is as a primary care physician for you financially. So if you think about it, when you have a primary care physician, you get your annual physical exam, and your physician's going to say, all right, we need you to see a couple of specialists. We need a podiatrist and a cardiologist or whatever it is. And so we take that generalist approach. We look at the full picture. I mean, every nook and cranny of someone's financial life. And then we bring in various specialists who are needed for specific situations: the sale of a business, the purchase of a residence, an insurance issue, an employee benefit issue, business matters, legal, tax, insurance, any of the things. And so for us, it allows us to be very much a navigator, a co-pilot with somebody. And we can be pretty darn objective because we don't work for an organization whatsoever that manufactures product. We are fiduciaries to our clients, but we do not have any W-2 except from BFG. So unlike working for a big bank or a trust company or a insurance company or some of the other big entities, we have no duty of loyalty to an employer because we have no employer. So our clients are functionally all our bosses, if you will.
Great. And it's almost like you had mentioned you had sushi for lunch. So it's almost like taking all the different pieces that go into sushi, wrapping it up all under one roll, and the clients have the benefit of that. Anything that can go in together, and that's one big total package that they can benefit from.
Well, every single household is different. We will send out a questionnaire and a document checklist and go through a full litany of things and read over all of the details of somebody's life, their legal documents, their tax returns, their employee benefit packages, all those kinds of things. We'll look at everything in order to do some analysis, to make some recommendations, and then to the extent folks want, to be able to do some implementation for them. The problem is most folks do financial planning like they do, it's whack-a-mole. It's, I need to get a car insurance thing over here, or, my kid is 18 and we have to get a power of attorney for him. Or it's one thing at a time. It's very task oriented, and it's never, I won't say never, it's rarely coordinated. These folks don't know what one another are doing. And so if you have a money manager and you have an insurance agent and you have a tax advisor and you have an estate planner, and they don't know what one another are doing, there will be mistakes. There'll be something in your will that doesn't jive with the beneficiaries on your IRA. And it creates serious problems in the tax world and in the planning world.
So would you say that though all the households are different, let's say, what is your typical client what do they look like? Is this, what is your median age range? It doesn't sound like you're going to be taking on folks who are obviously just starting out, or do you have some of the outliers that might be a little young that how do I really lay out the rest of my life? Or do you have people, kind of catching up? Tell us a little bit about who the folks are that are setting up an account with you.
It's a great question. And I would say, first and foremost, we deliberately cast a wide net because we have different types of ways to engage our firm. So for folks who are at the 10 or $20 million mark, we have a suite of services for those folks that people with that level of wealth require. For folks with $1 to $10 million, it's a different suite of services. And for folks under $1 million, there are plenty of planning opportunities and plenty of things that we can do. We have a program we call Financial Planning for All, which is designed to be an affordable, basic financial plan that allows either young people or folks who are just getting started to really do a good job. And so our price point and our service levels are different based upon what each family needs. Some are going to want a very high touch experience, and some are going to want to be pointed in the right direction and sent on their way. And, it's like when you go to Home Depot, you can buy all of the things you need to build your own house. Some people can do that. Most people can't. So they'll go and get the resources and then hire the right people and the right subcontractors to actually do the building. So
Right.
if we had a sweet spot, and we do, our typical client's younger than most firms. It's actually a differentiator for us. Most of our clients show up on our doorstep between 45 and 60 years old. Most of them are sandwich generation. They got parents getting older they're worried about. They've got kids they're still educating. They're working 60 or 70 hours a week. They're executives or professionals or business owners. They're busy as hell. And they need somebody to help wrangle all of this because in the little free time they have, this is not how they want to spend it. And so they have to figure out how they're going to take care of mom and take care of junior and retire themselves before they die. And it's a lot. And so for families like that, we really do get involved in a multi-generational way with multi-generational advisors and help the entire family through that process.
I think one of the things too, just by listening to you talk about the timeline of when you got started, even though you launched your company in 2003, and here we are knocking on the doors of 26. So that's about 23 years right there. But then you also have the experience of some time prior to that. So let's talk about a quarter of a century, not to date both of us there, but
Yeah.
to really look at it. One of the things that we were talking about in that time, what type of differences have you seen in the investor out there in the past 5 years, right before COVID? 10, 15, 20 years. I mean, there's got to be some differences and kind of where I'm going to is the effect of the 24-hour news cycle, different leadership in the White House, fears that people have, really searching so much, doing anything they need is at a click right now. And what do you see that doing to the investor out there?
Well, a couple things. First, it's made research and information a commodity. Everybody has the same research and information. There's really no secret sauce. And so anyone that tells you that they have some secret sauce is probably either lying or deluding themselves. There's so much information that really, I think the role of a financial advisor has changed into being much more of a coach and a guide and much less of an information provider. That's not to say we don't have to be experts in what we do, but it is to say that everything we do, none of it is neuroscience. There's nothing we do, nothing that people cannot do for themselves. So let's start with the premise that not everyone needs a financial advisor, but I happen to think most people benefit from one. In the same way, nobody needs a personal trainer, but there are lots of personal trainers and people know how to do sit-ups and push-ups, but maybe they won't unless somebody says, drop and give me 10. So I think there's an accountability to it. I think investors have changed by the generation, not just in the last 5 years, because the last 5 years to me it hasn't been a huge change. It's been subtle. But what has happened in my career, number one, is the information is no longer sacrosanct. It's no longer a big deal. Number two is that there is so much information that you can be paralyzed by it. And people have such short attention spans now. I mean, people get their news in 30-second clips or less. And so, and you see issues like meme stocks and some of the nonsense that's out there. And there are so many talking heads and there's so much bad advice. It's not even advice. It's just people are spouting off. And I do think that most financial news, in fact, most news in general, if we wanted to go there, but most financial news is filler. Most of it is conjecture and a lot of it's entertainment. Whether you're watching Jim Cramer or Susie Orman, for God's sakes, don't follow their advice. One size never fits all. They don't know you from Adam, and all they're doing is selling advertising and creating buzz. And, for Cramer to yell at the screen and talk about this stock or that stock and roll up his sleeves and carry on, maybe you find that entertaining. I find it stressful, actually, but maybe you find it entertaining. But for Pete's sake, it's not advice. And so let's remember that one size fits all fits no one, and that it is much better to get just like you get medical advice from your doctor and not from WebMD, you ought to get financial advice from your financial advisor and not from CNBC.com. That's not helpful. It's really a lot of noise. And it's been called financial pornography for a reason. And it's because it is this omnipresent noise of garbage. And there's so much of it. And you do have to fill a 24-hour news cycle. And how many times can you talk about Apple's dividend? How long can you talk about that?
You're right.
It's not important. It's not important.
On that, who does the financial planner turn to? Where do you, when you say, "Hey, I want to sharpen my saw," where do you go?
Actually, I go a lot of places, just personally. I attend the Heckerling Conference, which is put on by University of Miami School of Law, and that is an estate planning conference that's very high-end education. I'm a member of the Investment and Wealth Institute as a certified private wealth advisor, and all of that education is put on by professors at some of the top universities in the country and, in fact, the world. There's a lot of education that we're able to get, and then there's also various newsletters or subscriptions to educational information, whether it's Michael Kitz's or Ed Slott or some of the other experts out there, where it's not trying to tell you what the right answer is, and it's sure not trying to tell you what the right stock is, but it'll help us analyze the impact of a piece of legislation, for example, or the impact of a new rule or something that's sunsetting, or planning opportunities on the estate side or the tax side. So I think anybody who's telling you these are the 5 stocks you wish you had owned last week, that's not helpful. But for people to say, here's some strategies you might want to think about. Here's a great way to pass assets on to your kids, or a great way to support your favorite charity. Or I think those things are much more helpful. And we are inundated with opportunities for that education. We get a lot of it. I mean, even just my continuing education, because you mentioned all those credentials, it's like 200 hours a year. So I'm in school as much as I was when I was in school. And it allows us to stay sharp. It allows us to stay relevant. And it's not about the facts. It's about the strategies. The facts are easy to look up. If you forget what a limit is under an IRS tax code, you can Google it in 4 seconds. That's not what's important. What's important is how to use all that information, how to digest it, and how to ignore the noise.
Ignoring the noise. That's it right there. Because to your point, talking about, what are the 5 stocks you should have owned last week? That's exactly what it was last week. Somebody's coming to you for, their passive future, and I know that there's got to be pressure on that, if we all had a crystal ball, well, right now, you and I wouldn't be on this podcast. We'd be somewhere else. But
we might be on the podcast, but we'd be at a beach on this podcast, maybe. But yeah,
exactly.
Absolutely.
Well, I think the one thing too is that I think you and I, matter of fact, I'm pretty sure of it, that we have a knack for educating ourselves so that we can educate our clientele. Their best interest is our objective, and being able to share that information and know that we're giving them the best information. Hence the reason that we even have you here as a guest today. And then now how they choose to use it is something different. Hey, listen, I noticed behind you there on your backdrop, it's not just the BFG, but I see some clouds behind you there that talk about don't retire, graduate. What is that?
Well, I think it's a thought bubble. That is the name of the podcast I've been hosting now for a little over 6 years, and the name of the book, my third book, the most recent one. I'm finally using that English major, and it is a book and a workbook designed to create a plan, some financial literacy, and a financial plan for people who want to do this themselves. They want to get some information. They don't necessarily need or want to hire a financial advisor, and it is an easy way to build a financial plan. The workbook is 20 exercises that will build your plan. And the book itself is written in the first person. It's written to be accessible. It is not a textbook. I think it's a fun read. And, when I quote philosophers, it's not Aristotle, it's Chris Rock. So I think there's stuff in here that can be fun and accessible, and it's in everyday language. I minimize the jargon and the nonsense so that this can be picked up by just about anybody. Anybody old enough to understand basic personal finance, which could be an eighth grader, frankly, can benefit from this. And you can pick it up where you are. So whether you're 25 or 55, you can sort of join almost like being a transfer student in school. The Don't Retire Graduate is set up where instead of chapters, it's courses, and it's the freshman, sophomore, junior, and senior year of your financial life, because that's really what it is. The freshman year is figuring out student loans, figuring out employee benefits, figuring out budgets and cash flow and how to do some basic things. Sophomore year is, do I buy a house or do I rent? Am I going to get married or am I going to have children? What are the life-changing events and how do I prepare for them, if you can really prepare for some of them? Junior year is where you get into a higher income situation. You're talking about taxes. You're talking about investment planning. You're talking about growing wealth. And then senior year is not just estate planning and long-term care and things that sometimes aren't a whole lot of fun to talk about, but it's also legacy. It's figuring out what you want to leave behind and how you want the world to remember you. And it's a lot about what you want to be when you grow up. So I ask every guest on our podcast what they want to be when they grow up, and I've heard some fantastic answers. Sometimes people are prepared for it, and sometimes they aren't, and I can always tell the difference. But it's fun to ask somebody 80 years old what they want to be when they grow up, because no one's asked them since they were 7. And they wanted to be an astronaut, and they're not.
So then what's next, right? And that's actually, you stole one of my questions there, is that, if there is somebody out there and they're wanting to get started, age aside, what is the one thing out there that they really should know about financial planning?
It's a great question. And I actually think it's probably wise to break this down into 2 or 3 concepts that are important for everyone to know at any stage, but particularly if you're just thinking of getting started. The first step is inventory and figuring out where you are and being real honest with yourself. Be honest with yourself, be honest with your spouse or significant other, with your family members, with anyone involved, and be honest with your advisor. You don't go to your doctor, I hope, and lie about, oh yeah, I do smoke a pack a day. Like, you have to tell your doctor what you're doing. You have to tell your financial advisor what's going on. And sometimes that's intensely personal, and I realize that. But we can't do a good job if we only have partial information. So I think the first step is inventory. Know where you are. It is impossible to chart a course to where you want to be until you know where you are. Second thing is to pay yourself first. What so many households do is they bring in money from paychecks every 2 weeks or weekly or monthly or whatever it is. They spend money on bills and they hope something's left over at the end of the month. And that is not a good way to do wealth building. It is so much smarter to take 10 or 20 or 15% or whatever works for you and put it towards, whether it's excess debt pay downs for principal, whether it's savings, whether it's investments. That's going to be uniquely yours, but something where you are your own first bill. Because if you can live on 80 or 85% of your income and you continue to do that percentage as your income goes up, you can build real wealth. So pay yourself first. That is the second thing. And the third thing, just point blank, it will not be easier to start tomorrow than it is to start today. This is not something where inertia or putting your head in the sand will make it better. Don't wait for the next crisis du jour or the next news bite or the next election or the next legislation or the next turn of the calendar. Your financial life is easier to plan today than it will be tomorrow or the day after that or the day after that, because the biggest determinant of success, first is behavior, but second is time. So if you do the right things and you have enough time to do them repeatedly for a long period of time, you can build real meaningful wealth. And it's not about your income. It's about your behavior, and it's about how much you're able to put away. It is definitely not about income.
I participated in a conference this weekend on Saturday, day event for folks. And one of the slides that was up at the beginning, and then they also brought it back around full circle at the end, was, when's the best time to plant a tree? I'm sure you've used that one or heard that one before. And the answer was
20 years ago.
Yeah, there you go.
Oh, yeah.
And then they'll say, okay, well, when's the next best time to plant a tree? And it was yesterday.
Right now.
And to your point, the growth, you really just hit that. One thing before we before we started the show here earlier, Eric and I were getting a chance to know each other and talking with our other friend that's backstage there about, just the different things. And Eric touched on it a second ago, the 24-hour news cycle. One thing that I see, folks are, they're checking out all different companies. Folks are checking out all of Eric's different, competitors. If in that space you can consider them competitors, because just whereas all investors are different, so are all companies that take care of them or provide for them. But the 24-hour news cycle, information at a click, where you can get whatever you think might work best for you. And so one thing I have seen is that, along with Eric talking about the analysis paralysis there, is that even after talking to any of our competitors, reading every article out there and every different type of medium, when they finally have a conversation with me, and I know I'm giving them the best information, that not just what they want to hear, but what they need to know, that there's only one person left for them to trust, and it isn't me. It's them, and they can't even do that, just with everything that's out there. So one thing I'd like to end on, Eric, if you wouldn't mind, just even in your own words or things that you just truly know, what is one good thing that either in this market, in this space, this financial area where we are now, with politics aside, tariffs, whatever may make people be second guessing a lot of things, what is one light at the end of the tunnel that you can share with everybody today?
Well, I do think that a rising tide will raise all the ships, right? I think it's really important, and this is going to sound so boring, and I forgive me for that, but it's the right advice. It's important to have lots of different kinds of diversification. It's really important not to try and time anything. It is impossible to time the market. Peter Lynch was considered one of the great investors of all time, and Fidelity, when he retired, had 30 years to replace him with another great mind and couldn't. That's because they're not out there, because it's not a great mind. It's a wonderful track record. There have been so many stories like that. Timing anything is a fool's errand. I do think you want to own some of almost everything. And while that sounds really dull, every time I read about the tortoise and the hare, the tortoise wins. Every time. Give me X% return, whatever that is that's reasonable for you every year, rather than big ups and big downs, because the money, the sequence and series of returns matters, and the volatility matters more than the nominal number. If I can, I'll have a little fun with you. Let's do a little math. You all right with that, Kyle? Cool with a little math?
Terrible at math, but let's go ahead and try it out.
Now I'm going to put you on this. I'm going to put you on the spot. You have $10,000. You're going to invest that $10,000 for 2 years. In the first year, you gain 50%. In the second year, you lose 50%. What is your average annual rate of return?
I'm going to say my average is going to be 0.
Correct. Your average is 0, but how much money do you have?
I've still got my $10,000.
Absolutely not. $10,000 growing by 50% is now $15,000. Cut it by 50%, it's now $7,500. The average in the prospectus will say 0, but it's not a trick. The average is 0, but you've lost money. You've lost money because it takes a 100% positive return to make up for a 50% loss, which means the average doesn't matter as much as the volatility.
Gotcha.
You show me something that gets me 77777 for the rest of the time, it's the only thing I'd own. Doesn't exist, of course, or it's all I would own. But it is more important to single and double your way than to have lots of home runs and strikeouts. Because unfortunately, the losses are so magnified against the gains that they take twice as long to recover from, and they create an enormous amount of psychological torture. So, when a market turns, when we have a Y2K event or a Black Monday event or a recession of '08 event, or even COVID, which was short-lived but happened, the people who are buyers, who are dollar cost averaging, who are putting X dollars and paying themselves first into whatever it is, whether it's index funds or actively managed funds or a stock portfolio or real estate or bonds or anything, whatever they're doing, if you just keep doing it every month, then when there's a sale, when there's a drop in the price, you're buying more, you're getting more value for your money. Now, it is not a guarantee ever that dollar cost averaging will make you money, but it will remove the psychological torture from yourself of saying, is this a good time to invest, or should I wait for that jobs report Wednesday? It just doesn't matter. The strategy and the consistency matter so much more. Find things that aren't flitting about 50 up and 50 down and stick with it. I know it's dull, but the tortoise always wins. And it is the simplest. It is hard advice to render because people are like, why would I pay you for advice that's that simple? And it's because we just simplified 24/7 news noise into good behaviors that build wealth. It's that simple. This is not neuroscience. It's not. All of these principles exist. And if you can avoid the iceberg, the Titanic, if it had gone a little slower and missed the iceberg, would have had a very successful voyage. As soon as you hit the iceberg, it's hard to recover from that.
Well, Eric, listen, thank you so much for all of this. And I think that is one of the things that, we always share with folks. It's not always what you want to hear, it's what you need to know. And sometimes it's not always the neon lights and the smoke and the flash and everything else. And that's why I tell folks, if you drill it down, don't make it more than it is. Don't overthink it. And I think you really were the other voice or another voice out there that really helped echo that sentiment. So we really appreciate your time. Any last thoughts you'd like to share with anyone today before we head off?
No, I thank you for having me on, and I hope folks enjoyed this. And if you're looking for resources, by all means, check out the book or workbook or read more about what we do, and we'd love that.
Fantastic. And along with that note, if anybody has heard this podcast today and you've been on the fence and you now are looking to move forward, always remember you can access any of our educational webinars, our podcasts, and all of our print media that we've had over the year. The library is still fully active. You can always find anything you need at www.americanira.com. You can start your application process right from that website. And then you can also set up a consultation call with either me or someone else in our sales department. So with that, we're going to go ahead and wrap up this episode of the IRA Cafe podcast. Once again, Eric Brotman, thank you so much for joining us today. And hopefully we can talk to you again.
I'd love it. Take care.
You as well. For all of you that have joined us today, as always, it's a pleasure. We look forward to having you joining us again in the future at any one of our podcasts, wherever and whenever you are listening. Have a great rest of your afternoon and week.
American IRA, LLC, a North Carolina LLC, acts as a third-party administrator for New Vision Trust Company, a state-chartered South Dakota trust company. As a neutral self-directed IRA administrator, American IRA does not recommend or endorse any investments, individuals, or entities, including financial representatives, promoters, or companies. American IRA and the IRA Cafe are not responsible for other statements, representations, or agreements, nor do we evaluate the quality or profitability of any investment. American IRA does not endorse guests on the IRA Cafe podcast. Guest opinions are their own and do not necessarily reflect the views of American IRA, its subsidiaries, associates, or custodian. Participation in the podcast is voluntary and no compensation is provided. American IRA is not a fiduciary and cannot offer financial advice. Please consult your CPA or another professional before making financial decisions.